to talk taxes and end of year planning.
All right, let's do it. So let's start with end of the year planning, and then we'll talk about some changes going into 2024. So we're at mid of November. We got 6 weeks left of the year, which is crazy to even say. Any thoughts, strategies on taxes, just in general, Kevin?
Yeah, the first thing is, if you haven't been doing it throughout the year, tax loss harvesting, it's time to go through and see maybe some of those bonds or some of the bond funds or even some of the stocks that you own that weren't part of the Magnificent Seven have not done well. Well, you can take up to $3,000 against ordinary income with those tax losses. In addition, it can improve the tax efficiency of your portfolio if you were to sell, let's say, a small cap mutual fund and buy an ETF, as long as it's structurally different and isn't, a like kind investment, you can switch those out, and now you have a better tax basis. The second thing I would say is RMDs. If you have not done your RMDs for the year, make sure you do that. It's a very punitive penalty if you don't get it done before the end of the year. Those would be my first two. What do you got, Tom?
No, I think tax loss harvesting is underlooked and should be taken advantage of. Even if you don't have any taxes that are going to be due this year, it can carry forward to your point. So, and it's as easy as if you own a stock, let's say you own Exxon, well, you can sell Exxon. You have to wait 30 days to get back into it, or it's called a wash sale, or you can just buy Chevron the same day, which is, again, not the same stock, but it's the same sector and
Highly
it
correlated.
highly correlated. And you can do the same thing with ETFs. There's a biotech ETF with like four different companies, and they look and they feel the exact same. They just have different asset managers behind it. That's also allowed to do where you switch out the same ETF that second with another ETF to just carry forward that loss, because the tax delta and the tax savings is it starts to add up after a while. And when you have an after tax account, it's all about net return at the end of the day. So if you're in a higher, especially if you're
Yeah,
in a
and
higher
look,
tax.
the tax loss harvesting as far as a percentage gain on your portfolio, it's incremental, it's marginal. This isn't some breakthrough idea. This is, on the margins improving your portfolio. So it is important to do. If you don't do it, it's not the end of the world, but we're all in it for 30 or 40 extra basis points. That can make a meaningful difference on long-term returns. So the next thing I would mention is charity. If you're planning to give, try to plan it out before the end of the year. You can work with an advisor like Tom or myself, and you can go through and say, would it be better to give this year or next year? And we can go through your tax planning and say, okay, well, this makes sense for you to do it now versus, in 2024. Maybe it it doesn't make a difference either way, but one thing to consider is if you have a big income year this year, making a bigger charitable donation this year to offset that, especially if you think income might be down next year. And there's a few ways to do it. One, you can do it with cash. Two, you can do appreciated securities. You can do artwork. You can do jewelry. You can donate a lot of things. And one vehicle that's very helpful is called a donor advised fund.
Yeah, and I don't want to. We could probably take a whole episode on the donor advised fund, but it's just you can donate as much as you want to it that year, and you get the tax write off, and it's especially good for your to your point if you have a big income year, or maybe you sold a business, and you have charitable intentions down the road, but just don't want to write a massive one time check to a charity. You write to the donor advised fund, and then you let that investment grow within it. Then you can take at your time, you can to your charity of choice. You can do it on a monthly basis, annual basis, doesn't matter. It's out of your state. You got the deduction for that big income year, and it's a great resource. And you can just Google donor advised fund, and there's a ton of resources on it, and they explain it pretty well.
Yeah, there is a limit on how much you can donate. It's in some cases, depending on what you donate, it could be 30% of your adjusted gross income. In other cases, it can be 50% of your adjusted gross income. But just like tax loss harvesting, if you're above that, you can carry forward those charitable deductions in that excess until you exhaust them. So if you do donate too much and you don't have the AGI to support it, we'll just carry forward. You can do that deduction next year.
Yeah, so let's talk about pre-tax accounts. I think this is an important time to look at your 401ks, to look at your IRAs, and to make sure if you have the means or if you have the intentions to max them out that you're there. For this year to max out your 401k, it's 22,500. An additional 7,500 if you're over the age of 50. For Roths and traditional IRAs, it's 6,500 for this tax year and 7,500 if you're over 50. And for the IRAs and the Roth, you have until tax filing of the following year, so April of next year, to contribute to those plans, but the 401ks you don't. You have to max those out by December 31st. It's easy to do. If you're not there and you want to max it out, you can call your benefits group or your HR and have them increase your deferral option. Usually takes one pay cycle to kick in and try to max it out before year end.
Yeah, and I think one thing to mention is that it can help to work with either a CPA or a advisor like ourselves to figure out, does Roth make more sense, or does the pre-tax doing traditional IRAs or at work, your 401k, either traditional or using the Roth. The kind of rule of thumb is if you're in the low 20s for your tax bracket, it's kind of a gray zone where it might make sense to do one or the other, and that's where advice can come in helpful, is actually looking at your unique situation and helping you with that. But if you're in a very low rate, let's say the 10 or 12% rate, Roth tends to be a better thing for you, and hopes that your rates in the future will be higher. And it's the opposite. If you're in the 37% tax bracket, you want to get as much pre-tax money in there as well, because you can make that part go away. Then you're only paying 35 at the highest level. So, if you need help going through the progressive tax code and how it impacts you and where to do that, we can help. A CPA can help. There's some good information online as well.
Nope, very good. Let's talk quickly and end on what are your thoughts next year for taxes? You want to talk quickly about just some changes that are taking place that we know about?
Yeah, so the contribution limits that you just mentioned for 2024, the 401k goes up $500 to 23,000. Plus, you can do 7,500 if you're 50 years or older. And for IRAs, it also goes up to 7,000, up from 6,500. So both of them going up $500. And again, you can add more if you're over 50. So that's a big one. One we've talked about before is the expiration of what's commonly called the Trump tax cuts. There's some major estate planning and gifting that you can do that you really got to get done either 24 or 25. We don't know what will happen with that afterwards. But what's nice is that we've had a threshold increase of 5.4%, as reported in the Wall Street Journal. The tax brackets are jumping. So one of the, I guess, good problems of inflation is that now if you made a little bit more money, your bracket has expanded. So if you're thinking about, maybe I can take income in December versus January, it could be advantageous, if you have the ability to delay that income or recognize that income, to recognize it for next year, because the brackets are jumping, and that means you pay lower taxes overall.
Yeah, that's a good point. It's a really good point too on the sunset of Trump's tax law, which ends end of 2025, so beginning of 2026. So we have remaining this year, 24 and 25, and there's some hefty reductions that are coming down. So if you have estate planning needs and means, please reach out, because there's planning needs to start now as opposed to waiting to last minute for those tax benefits.
Yeah, and the standard deduction is going to go up a little bit next year as well, and it should be a little bit higher in 2025. But then that thing's getting cut significantly in 2026 unless Congress takes action, which, as we've seen from this year, they're not great at taking action. So I'm not sure that anything's going to happen except expiration. So making sure you maximize your deductions if you're going to do it itemized, or figuring out whether standard or itemized is better for you, is an important thing to consider. And at the end of the year, you have a pretty good rough estimate of what your income is going to be, and you can make decisions like Roth versus traditional, and know, okay, I made the right one for this, or hey, do I give now or do I give next year, or do I, find a couple other strategies to minimize my tax burden. So lots to do for the end of the year. If you have a good advisor, hopefully they've already told you about this stuff. If not, give Tom a call. He'll be happy to help.